What's going on, guys? In today's video, we're going to talk about what is a stock and how can stocks make you money. If you've never invested before, stocks can be a little bit confusing. And you hear people say, oh, you want to build wealth, invest in stocks. You want to make money, invest in stocks. And you're like, the hell is that? So in this video, we're going to break down what a stock is, how the stock market works, and do it in a way that's easy enough to understand if you're just a beginner. I'm only going to be talking about publicly traded common stock in this video. And if you don't know what those words mean yet, that's okay. But I'm not going to be talking about things like private stock or preferred shares. All that stuff's kind of out of the scope of this video. And most of the things that you hear on the news about stocks in the stock market has to do with publicly traded common stock. Because I'm going to go through the topics and explain what they are first. And then we're going to go through a very simple example to kind of tie it all together. Y'all ready? Let's go. So what is a stock? Stocks are investments in companies. They represent a part ownership in a company. And people buy stocks with the hopes of investing in a company to get more money back than they put in. And you might wonder, why would a company give up partial ownership? Well, the reason that they do that is to bring in additional money to fund or expand their business. So what happens is they decide to issue new shares of stock. They put those out on the open market, and the money that they get back from that is what they use to expand and run their business. And you might have heard of companies having an IPO. An IPO is an initial public offering, which is basically the company's initial release of their publicly traded stock for people like you and me to buy. And once a company issues that stock and they get the cash and they go expand and run their business with it, those shares trade on a secondary market, and that's the stock market. So when you buy a stock in your brokerage account, you're not actually buying it from the company. You're buying it from other people or institutions that have that stock and are willing to sell it. So how do stocks make you money? Stocks can make you money in two different ways. One, the stock's price could go up from what you paid for it, and that's called price appreciation. If the business continues to do well and more people believe it's going to be a good investment, then they'll be willing to buy the stock at higher prices. That makes the price go up. But on the other hand, if the business doesn't do well and people start losing confidence in the business, then people will be willing to sell their shares for lower and lower prices, which makes the price go down. And because the stock market's open almost every weekday, the prices fluctuate a lot on any given day and throughout the day. And sometimes it's because of what the business did. Maybe they missed expectations or they had a scandal. And sometimes it's just whatever else is going on in the world is impacting their stock price, and it had nothing to do with anything that they did. The second way the stocks make you money is when companies issue shareholders dividends. A dividend is a distribution of company profits to shareholders in the form of cash. Who doesn't like when people give you cash, right? So not every company issues dividends, but the ones that do evaluate their business every quarter or every month, and then they decide how much of a dividend to distribute to their shareholders. And usually companies try to create a stable dividend that increases over time because it shows that the company's strong. Okay, so that was a lot of information, and you're probably like, this video sucks. I thought it was going to be easy to understand. Well, we're going to go through an example that I think is going to help a lot. So imagine you have a friend named Jeff, and he started a lemonade stand. And Jeff's lemonade stand is the best lemonade stand in the whole neighborhood.
Once it hits your lips, it's so good.
And Jeff's doing pretty good with the lemonade stand. He's bringing money in, but he has visions of expanding way beyond just your neighborhood. He wants to take his lemonade stand idea national. Different states, bigger lemonade stands, more options. He's dreaming big. But in order for Jeff to do that, it takes a lot. He has to buy more ingredients. He has to hire all these people to run these lemonade stands across all these states. He has to train everybody. That costs a lot of money. And that's money that Jeff just doesn't have. But what Jeff does have is a big idea and a good business that's doing well. And because his business is doing well, there's people that know Jeff that are willing to give him money to expand his business. And they do this because one, they probably believe in Jeff, and two, they believe in Jeff's business and think that over the long term, it can bring them in more money than they give them. We won't talk about this much, but that's basically ROI, return on investment. What's the return I'm going to get for the money that I give you? But they think so much of Jeff's lemonade stand and Jeff and his big idea that they think the return on investment of giving money to this lemonade stand is going to be worthwhile. So at this point, Jeff decides, you know what? I'm going to sell you guys shares in my business because I want this money and I want to expand. So you give Jeff the money to expand his business, and he gives you back shares or stocks in his company. And that is kind of like the initial public offering for Jeff's lemonade stand. So at this point, you have shares in Jeff's company, and Jeff has the money to go expand his business. So he goes and he starts getting to work on getting that business off the ground. And you as an investor are holding shares in Jeff's lemonade stand business. And let's just say that each share is worth $10 based on how much money you gave Jeff. When other people see that you own shares in Jeff's business, they're like, oh man, Jeff's lemonade is awesome. I think his business is gonna do so well in the future. I'll buy those shares off you for $15 a share. And that's kind of how the stock market works. It's a public place where people can buy, sell, or trade shares of companies that they own. So now your shares that you paid $10 for are worth $15 because that's what someone else is willing to pay for it. That's price appreciation. So you can decide to sell your shares and take your win, or if you think that Jeff's business is still going strong and going to do even better in the future, you can hold on to him and wait till it goes up more. And then maybe the next day, Jeff has a bad batch of lemonade and people in the neighborhood get sick. And all of a sudden people in the market say, whoa, I'm not giving you $15 a share for that. I'll give you $8 a share because I'm not sure how well Jeff's lemonade business is going to recover from this bad batch. So as you can see, every day the value of your shares change depending on how people feel about the business. So you can decide to sell your shares at a price that you're comfortable with, or you can continue to hold them as long as you continue to believe in the business. Now let's imagine that Jeff's lemonade stand recovers from the bad batch incident and they really start to do well. He's rolling out to all these states, the money is flowing in, things are great. He's at a point where he has more cash coming into the business than he can spend. So he decides he's gonna start giving a dividend to shareholders. And Jeff decides he's gonna give a 25-cent dividend every 3 months to every shareholder. What that means is that every 3 months, for every one share in Jeff's business that you own, he's gonna give you 25 cents. So over a whole year, you would get $1 for every one share that you own in company profits. Remember, you pay $10 per share and you're gonna get an additional $1 in dividends every year. That's a 10% dividend yield, which is really high, by the way. That's not normal, but it's good for this example. And that's on top of any price appreciation that you might get if the value of the shares go up. So let's take a look at the math. Let's say you gave Jeff $1,000 for his business expansion. He gave you 100 shares in return at $10 each. Now he's going to give you $100 a year in dividends at $1 a share per year. And that's for doing nothing. Jeff's doing all the work and you're just getting a piece of the profits. And this is the beauty of stock investing, and especially investing in dividend companies. You don't have to be a business whiz. You can put your money into companies that you believe in, that are profitable and are doing well, and over time, they'll continue to pay you. Now imagine you invested $10,000 into Jeff's business. You're getting $1,000 in dividends a year. And you can keep adding zeros to see how it adds up. Plus, if the business continues to do well, people will be willing to pay higher and higher prices for shares in Jeff's lemonade company, which means the value of your shares go up. And that's basically how stocks in the stock market works. It's you putting money into companies that you believe in and that are hopefully profitable over a long period of time. And those companies share those profits with you, either with dividends or with the value of the stock going up. It's pretty sweet. So just as an example, let's take a look at Warren Buffett's Berkshire Hathaway. You've probably heard of Warren, probably the most successful investor of our lifetime. His company is called Berkshire Hathaway. And if you would have bought one share of Berkshire Hathaway in 1980, it would have cost you $275. And now Warren and his team have done such a good job at managing the company over the years that right now, one share of Berkshire Hathaway stock is worth about $500,000. Wait, what? So look, the reason why people buy stocks is they want to grow their wealth over time. And investing in companies is still one of the absolute best ways to do that. One of the reasons for that is that it's accessible to most people. All you need is a brokerage account to be able to start buying shares in companies. And when you have apps like Cash App that include investing in their experience and it's so easy to do, the ability to build wealth is easier than it's ever been. Hopefully that helped. That's the basics of stocks and how they work. If you guys have any more questions about stocks or getting started investing as beginners, put them down in the comments below. If you guys want to see more videos on stocks and financial independence, click on these videos on the end screen. I'll see you guys in the next one. Peace. So did you guys like my lemonade stand example? Who's ready to go run out and start a lemonade stand, right? Am I right?